As the market navigates the morning session, shares of Tilray Brands, ticker TLRY, are currently trading at $1.74, reflecting an intraday loss of 2.51%. Now, while many investors see that price and immediately think of the long-promised, yet-to-materialize cannabis legalization boom, they are fundamentally missing the critical story unfolding within Tilray's balance sheet. The real narrative isn't about future legislative wins, it's about a desperate and aggressive pivot into the beverage alcohol market, a move that is simultaneously the company's greatest hope and a potential source of its undoing. The expectation is that you are buying a ticket to the cannabis gold rush. The reality is that you are investing in a heavily indebted craft beer and spirits conglomerate that just happens to also sell cannabis, and the performance of that cannabis segment is becoming an increasing liability to the overall enterprise. This is the disconnect that the market is struggling to price correctly, leading to the immense volatility we witness daily. The common belief, perpetuated on forums and across various online investing platforms, is that Tilray is a coiled spring, ready to explode upwards on any positive news out of Washington, D.C. regarding cannabis reform. Investors using the simple interface of the Robinhood app or those practicing self-investing through SoFi Invest often buy into this straightforward narrative. They see a beaten-down stock far from its all-time highs and perceive it as a generational buying opportunity. The expectation is simple: legalization equals profit. However, the challenging reality, which requires a deeper dive than a quick glance at a stock chart, is that Tilray's operational performance is what's truly dictating its trajectory. And right now, the fundamentals are flashing warning signs. The company is in a race against time, trying to build a profitable consumer packaged goods empire before its cash reserves dwindle and its debt obligations become insurmountable. This isn't a simple growth story like the early days of Apple stock or the clear-cut AI dominance of Nvidia stock. This is a complex turnaround play fraught with existential risk. The daily trading action reflects this tension perfectly. In recent weeks, we've seen significant volume spikes on days with no specific news, indicating a battle between retail speculators and institutional short sellers. The stock has been trapped in a tight range, with key resistance levels proving difficult to breach. Any rally is met with swift selling pressure, suggesting a lack of conviction from larger pools of capital. When you analyze the order flow on a platform like Interactive Brokers, which offers more granular data, you can see large block trades executing at key technical levels, indicating that sophisticated traders are exploiting this volatility rather than establishing long-term positions. This isn't the kind of stable accumulation you'd see in blue-chip Fidelity ETFs or trusted Fidelity mutual funds. Let's dissect the recent performance. The company's latest earnings report was a microcosm of this entire dilemma. While management celebrated the continued growth in their beverage alcohol segment, led by brands like Sweetwater Brewing and Breckenridge Distillery, the Canadian cannabis market remains a quagmire of oversupply, intense price competition, and shrinking margins. Revenue from that core segment has been stagnant, and the gross margins are being compressed. This is the inconvenient truth that gets lost in the hype. Tilray is effectively using the stable, albeit lower margin, cash flows from its beer business to subsidize its struggling cannabis operations. This strategic pivot makes sense on paper. Build a non-cannabis distribution network and brand portfolio that can immediately pivot to THC-infused products upon federal legalization. It's a Trojan horse strategy. The problem is the cost of maintaining this strategy. The company is burning through cash, and while its debt load is manageable for now, any further operational missteps or delays in legalization could force it into dilutive financing, further punishing long-term shareholders who opened an individual brokerage account with high hopes. Many investors using Fidelity or Schwab Intelligent portfolios for their core holdings might allocate a small speculative portion of their capital to a name like TLRY, but it's treated like a lottery ticket, not a core investment. The company's attempts to achieve profitability have been a moving target, with adjusted EBITDA figures often excluding significant costs that paint a more grim picture of its financial health. So what exactly does Tilray do? At its core, it started as a Canadian licensed producer of medical and recreational cannabis. Through a massive merger with Aphria, it became one of the largest cannabis companies in the world by revenue. It has a significant presence in Canada, a strong medical cannabis footprint in Europe, particularly Germany, and a strategic but currently limited foothold in the United States through its holdings in MedMen and its CPG diversification. This diversification has been aggressive. The acquisitions of multiple craft breweries and a spirits distillery were designed to give Tilray immediate revenue, branding power, and a crucial distribution network across the U.S. The expectation was that these acquisitions would smooth out the volatility of the cannabis market. The reality is that the craft beer market itself is facing headwinds, with slowing growth and competition from spirits and other ready-to-drink beverages. Tilray bought into a mature, competitive industry as a means of de-risking, but in doing so, it has inherited a new set of challenges that are not insignificant. They are now competing with beverage giants, not just other cannabis producers. For investors on investing sites looking for pure-play exposure, this has muddied the waters considerably. The simplicity of the bull case has been replaced by a complex multi-front business battle. It's a far cry from the focused tech disruption narratives that propel stocks like Tesla stock. The Fidelity mobile app or SoFi trading platform might make it easy to buy shares, but understanding the intricate web of Tilray's operations requires significant due diligence. Looking ahead, the future of Tilray hinges on a few key catalysts and risks. The most significant catalyst, without question, is U.S. federal cannabis reform. The potential rescheduling of cannabis from Schedule 1 to Schedule 3 would be a monumental step, potentially easing banking restrictions and allowing for institutional capital to flow more freely into the sector. It could also have favorable tax implications under Section 280 of the tax code. This is the event that every shareholder is waiting for. A full legalization bill, while less likely in the short term, would open the floodgates for Tilray to leverage its beverage distribution network and become a dominant player overnight. Another potential catalyst is its international operations, particularly in Germany, which has moved forward with its own legalization framework. Tilray is well positioned to capitalize on the European market, which could provide a significant non-Canadian revenue stream. However, the risks are just as potent. The primary risk is the status quo. If U.S. legislative reform continues to stall, Tilray will be forced to continue operating its disparate businesses with limited synergies. The cash burn could accelerate, and the threat of shareholder dilution through at-the-market offerings or other capital raises becomes very real. Competition is not standing still. Other Canadian LPs are fighting for the same shrinking market share, and U.S. multi-state operators are building stronger brands and balance sheets while waiting for federal laws to change. For anyone considering an online investment in this name, it's crucial to weigh these binary outcomes. Services like Fidelity Wealth Management or robo-advisors such as SoFi Robo-Advisor would likely advise extreme caution given this level of uncertainty. It's a stock that requires active management and a strong stomach for volatility, not a set-it-and-forget component of a retirement portfolio like one might find in broad Fidelity IRAs. Comment below with your honest take. Do you think the government will pass meaningful cannabis banking reform in the next 2 years? I'm genuinely curious to see the range of opinions on this. In conclusion, the story of Tilray is a powerful lesson in the clash between market narrative and operational reality. The expectation, fueled by a simple and compelling story of inevitable legalization, is that of a future cannabis behemoth available at a deep discount. It's a narrative that's easy to understand and sell, especially to retail investors looking for multi-bagger returns through platforms offering Robinhood stock trading and Robinhood fractional shares. The reality, however, is far more complex and uncertain. Tilray is a company in transition, attempting a difficult pivot into a competitive consumer goods space while its core cannabis business struggles under immense pressure. The balance sheet is strained, and the path to sustained profitability is contingent on external factors, primarily legislative action, that are entirely outside of the company's control. The stock's performance isn't a mystery, it's a direct reflection of this tension. It's a high-stakes bet on the timing of political change, and until that change materializes, investors are holding a speculative asset whose fundamental value is deteriorating. The expectation is a growth story, the reality is a turnaround story, and those are two very different kinds of investments.